Hello, reader. Right. Okay, we're going to cover. This is the part two of covering covering my ideas from 2020. So I'm very conscious that my last video was over an hour and a half, and yeah, it's very hard to just be very brief um, with these things. But what I'm going to do is cover these ideas in this second video. And what I'm going to start, I'll just start at the top and work my way through. So the IP group has, to be fair, had a pretty horrendous year, as in its share price performance. It dipped down to just really astronomically low levels. I mean, it was to the point where it was getting silly, to be fair. And they've actually had, as far as realizations and as far as news flow, a pretty successful year. And we've not seen any blockbuster health tech announcements, which has been a pity. Those are still coming. So yeah, I still really like IP Group. I mean, but we've seen realizations from intelligent ultrasound. We've seen feature space. We've seen some other Garrison, another notable one. So they've been buying back shares at a fast clip, and rightly so, because I mean the stock is on a really large discount. They do have a large holding in Oxford Nanopore, which is cash rich, but is still burning cash, is heading towards profitability, forecast to reach profitability. Um, I mean, I've looked at it and it looks pretty good, actually. I've looked at how it compares to Illumina and Pacific Bio are the two main competitors, and it holds up well. I mean, it's got a loyal following of scientists that uh, swear by it, and there's pros and cons to each of the three technological platforms, but the whole area of mRNA and genetic um, understanding the genome and doing clever things with the genome and genomics is a vast area. And the I think the bit that the market doesn't necessarily get is that if you can take it beyond the laboratory and into industry, into applications, that there's this much larger market. I think 140. Now, I don't want to get my billions and trillions the wrong way around, but a large addressable market, and also just lots of other. But it has suffered. It has suffered from the derating of Oxford Nanopore. I mean, if we have a look at ONT, let's see what it's done this year. So, on a year basis, it's down from about 190 to 130. But we can see, there's been times where it's dipped down sub £1 and returned back to 160. So yeah, look, my point of view, I mean, it's just joined the FTSE 250. It's well into the 250, and it was to do with a change of classification that caused it to join, because it was classified differently. Not that I'm a great expert on the FTSE 250, as people will know, but yeah, I can see the remaining holdings of IP Group doing very well. Some of the clean tech holdings, Bramble as one example. I mean, they're working towards hydrogen buses, and whatever you feel on the topic, it's happening. That they are working very diligently towards finding a replacement to fossil fuel powered public transport. That's a priority for the UK government and for other governments, and net zero. Um, whether hydrogen makes it as a fuel source, the jury's out. I mean, human ingenuity. I'm a great believer in human ingenuity, and we've managed to, people would have spoken about solar panels and said, oh well, they're a waste of time. They only operate at a few percent efficiency, blah blah blah. And here we are in 2020, on the cusp of 2025, and um, efficiency levels of that would have been unthinkable 2 decades, 3 decades ago. Unthinkable. They're now the cheapest form of power, um, by a long way, by a long way. Um, and simplest, that yes, they only work when the sun shines, or more accurately, they only work when there's solar irradiance, so it doesn't actually need the sun shining. Well, one of the encouraging things, in fact, is uh, here we are on the 31st of uh, December, and I haven't sort of checked this before. I'm just going to throw this up on the screen, but just to kind of give you an idea. I mean, right now, 3.5%. I mean, outside for me, it's cloudy and murky. I've been out this morning. I've trying to get my steps above my 2022 and 2023 steps. So I've been stepping, listening to some podcasts and different things. So anyway, I digress. The 3.5% of the UK's electricity is being generated by solar. So I mean, I see things all the time where people say, "Oh well, renewables are a load of rubbish." Well, sorry, but where's the evidence for that? And like here, you know, um, 60 over 60, 61.2%. Well, actually more because of the hydroelectric, as well, 63.4. 2/3 of our power right now is no, on the 31st of December, when it's not a sunny day. um, 2/3 of our power is being driven by renewables. And then you've got interconnectors, then you've got storage, and different forms of storage. So yeah, look, I think that can we get hydrogen to a competitive price point, green hydrogen to a competitive price point? I'm pretty optimistic. I'm not a scientist. I'm just somebody that reads that. The progress they're making is substantial, but there's more progress to make. Is the point. And actually, even if long term it's not a viable form of storage and an energy medium, something else will be. That we will have a form of technology that will come through, um, because it needs to. I mean, as a society, we need to find a replacement to fossil fuels. And that yeah, that anyway, I'm not going to get too into that whole piece, but they've got some really interesting clean tech ideas. Fusion is another one, actually. Don't get me started on that. But regardless of whether fusion actually ends up working, there's enough money going into it that, from an investment point of view, first fusion should and will, I think, do well over the next years, and have done well. I mean, they've generated a pressure that was record breaking, world breaking. And the technology is, that you have to produce fusion power under very high gravitational pressure, because that's what the sun does. The sun is an enormous ball, and the pressure and the gravity pull of the sun. If you were thermal enough to stand on the sun, um, your thermal proofness, if I can use those words, wouldn't matter, because the gravity would, flatten you in an instant anyway. So not everyone knows these things, but that's that's the challenge with fusion, is to kind of replicate that level of gravity, to make fusion power economical. But they're getting very, very close. It's an intriguing technology, and once they've cracked it, it can potentially present unlimited energy to the world. And once you've got what unlimited energy, well, even if sucking the carbon dioxide out's not terribly efficient, if you've got unlimited energy, it doesn't matter. So it could be a way that we solve the world's ecological problems through fusion. Anyway, I, I'm very conscious that I'm 10 minutes in and I've not even covered one of my 10. So look, let me sort of move forward perhaps a little bit more quickly. So these, IP Group, also is very, cash, has a good level of cash. When I looked at the realizations and the cash, I mean, at the time the market cap was 475 million. Today it's, I think, 500 and ish, 523. So it's still, there's still a vast opportunity. 523 versus, the either the quoted companies, cash, or the realizations. And this was the fact that ONT had, Oxford Nanopore had risen in price since June. Kind of left you, I mean, yes, there's borrowings as well, that you're kind of looking at, you're paying 50 million quid plus 200 borrowed. So you're paying 250 million quid for 840-ish million of holdings, where the vast majority of the time they're getting uplifted. So we're not talking about holdings that are not worth something, or at least when they're being, when follow-on money is going into these 842 million, majority of the time, when we're talking, somewhere between 60 and 80% of the time, they're going in at an up round. In other words, the valuation is increasing. So to me, it's a no-brainer. I mean, I've looked at this, over a lot of, different angles, and actually, just the other thing I would call out is when you just look at the news flow. I mean, this news flow, it's just non-stop good news. So this was the 128 million realization. This was a realization of cash for its holding of ultrasound. But yeah, just continual good news coming through from holdings, and they do have a lot of holdings. There's a lot of moving parts to get your head round. Talking of lots of moving parts, here's another one with lots of moving parts. But again, the share price is virtually backed up by cash, and by the value of, um, the Bank of Georgia and the water company. So once again, I mean, you're paying very little. And actually, this article, "Let the Beer Do the Talking," which on New Year's Eve is probably a quite a prescient, article name. But anyway, um, uh, if any of you are talking like that later on, then, just let the beer do the talking instead. Anyway, yeah, look, I mean, you're essentially getting it at a massive discount. And yes, there are protests, and yes, there are things going on in Georgia. I mean, you can look at it different ways. You can look at it from a morality point of view or a freedom point of view. Mel Gibson freedom. Um, but look, ultimately, I suppose you've just, as an investor, you need to look at it from a risk point of view. You need to look at it from a, you know, and I don't ultimately know what will happen in Georgia. I mean, will it all just implode, and is there a risk? Yes, of course there is. But are you getting richly rewarded for taking that risk? Yes, yes, as well. For people that took the risk during 2024 and even before that. Um, you know, what happened to them? Well, they did very well. So I just don't see the risk return is the odds are in your favor, or at least that's how I see it. That's how I see the pricing of it. And actually quite a lot of these holdings are uh, some of them are actually in Armenia. They're not even in Georgia. Um, the acceleration of the portfolio is something that I've called out particularly. So what I did was I took the H1 figures, I took the 2023 figures, compared them to 2024, and what you see is some real, and this is just the portfolio performance. This isn't because the portfolio themselves have got debt and have got uh, uh, they're sort of part 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 holdings, that kind of thing. So what we're looking at here is the portfolio performance, which includes paying down debt and so on. Um, but it's a very impressive, very impressive performance. Growth performance. So not across the board. There are some that the insurance was struggling, the others were struggling. Others included the beer company that sold, interestingly. So obviously wasn't struggling that much, and yeah, the I suppose the point here about it's an exceptionally strong performance. I mean, those are not just throwaway words; they're backed up by the numbers, as far as I can see. What we also see is just strong cash generation. We see strong levels of buybacks. This doesn't pay a dividend, but they do very aggressively buy back shares. And I mean, the beer company sale is the latest realization, and that's the first realization since the water company. But the water company, when I went back, and actually it was interesting. There was some readers that said, "Oh well, the valuations are too high. They're valued at 10 or 11 or 12 times." And by the way, you can go to um, the CGEO Capital Georgia website and just run your own valuation. If you want to, you can sort of put in a PE, a valuation metric, and arrive at a result. So it'll say, well, this is how much it's worth. So you can go in there and plug your own numbers in, but I don't feel that their valuations are aggressive. I don't. If anything, they're quite conservative, and they've proven to be conservative because um, the sale of the beer business, the sale of the water business are two examples where they'd valued it at one level and it sold for more than that. So the evidence is not there that they are over egging the pudding. Far from it, quite the opposite, actually. Yeah. So look, I really like this. I think yes, there's risk, um, but I suppose if you can look past the obvious, like, oh, it's going to be taken over by Russia and all of this sort of thing. I mean, if you look at it another way, I mean, Georgia Dream, the political people in charge, are trying to steer a course between the EU and Russia. Obviously two power blocks, the West and the East, if we call it that. I mean, majority of the trade with Georgia, there isn't that much trade between Georgia and the EU. It's about 10%. There are a lot of expatriates, Georgians living, working in the EU, uh, remitting money back to Georgia, which is one of the reasons that the Georgian economy is so strong, I believe, is the money that comes back from people working abroad and sending money home. They're earning money. I mean, you're earning German wages, sending money back to your family. And German wages are a lot of money in Georgia. So, when they're recording economic growth of 6-7%, I mean, that's a large reason why. But that money flowing from the EU, from expatriate Georgians, is nothing to do with trade flows or joining the EU. I mean, yes, if the EU shut the door on Georgians working in the EU, if they throw them all out, yeah, that would have a bad effect on on Georgia. But I've not seen anything to that effect. That's what the EU are planning to do. I mean, clearly the Georgian dream political, the government of Georgia appear to be sort of moving away from the EU, or at least sort of not staying closely aligned, and that's what's caused the protests. Um, I mean, I quite liked what the CEO had to say about it, because obviously it's a question that investors asked at the last investors call, or at least I think it was the last investors call, and he said, "Well, look, we just get our heads down and get on with business. Like politics is politics. We don't care. We're just interested in carrying on. Just make our businesses as successful as they can be." And I quite liked that answer, and it's, I suppose, yeah, that's the reality of it. And it's the same in any country. It's the same in Britain. I mean, you might not agree with everything that the Labour government are doing, but you just get on with your job and you get on with your running your business, and that's what you do. So yeah, look, I just don't feel that it's a vast risk, but there is a risk. I mean, I can understand why people would say, "Oh, well, I don't want to take the risk." Fair enough. It's a free world. Uh, anyway, moving on to Augmentum. Oh, and sorry, I haven't been saying, like what have these done this year? So, where were we? IP Group is down 8%. So it was down a lot more. It's creeping back up in 2025. I think it's going to continue to creep back up. I mean, the NAV is well above £1, so it's trading at well over 50% discount to NAV. Yeah, look, but that's its performance. Well, there's still another hour to go until the stock market closes, but let's assume that it doesn't change in the next 50 minutes. The sorry, it was yeah, CGEO is up 17% this year. So when I looked at it, it looked incredibly cheap, and here we are. It remains at so it's at £12 today, £12 and 2 pence today, and that was below £10 until quite recently. So despite the protests, despite the elections, despite all of that, it's just carrying on. And I suppose there's enough people that are saying, do you know what, like the sky's not falling in. Perhaps the sky's not going to fall in. So who knows? And the other one is Augmentum. So Augmentum is at -3%. So yeah, it's not really gone anywhere in 2024, but has had some I think, pretty good progress. I mean, certainly when you look at, there's been one or two disappointments. This money's bought by Pocket. So it turns out, I think I said that this was a disposal. I actually need to change this article, that Augmentum actually, they didn't sort of say it at the time with the RNS. In fact, they didn't RNS anything about it, but in their interim results, so I still need to write an article about that, I guess. They talked about how they now held shares in Pocket, but at a lower valuation. The I think it was held at a different, and actually they talked about losses without going into what those losses were, and it turns out this was a large part of that loss. But yeah, I mean, apart from that 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 one, overall it's trading at 42%. Well, I mean, at the time, so this is back when when I wrote this article, it was on, have I got the market price on here? Yeah, I've got the market price at sort of 98p. So today it's at 107. So it has gone up about 10% since this article. So discount would be about 37, 38%. But strip out the cash and then you get to about 45% discount, which is incredibly cheap when you consider you've got Tide that's growing fast, really fast. The Tide's coming in, and they're seeing vast growth into India. In fact, I go and look up the news flow, and I'm literally changing the numbers from like that was 250, and now I'm changing it from a 2 to a 3. Yeah, in fact, I say it here. Look, excuse me, it's up from 225. So 125,000 customers. So it's grown 50, it's grown its Indian business 50% in six months. I mean, like, come on, that's pretty jolly good. Um, and there's a huge market to go after because there's 63 million businesses. I sort of linked that through to that website there. 2.2 million small businesses in Germany, and these guys Tide. I mean, yes, it's a bank. It's a bank, but it's sort of more than that in the sense that they offer a wraparound set of services. So yeah, looking at this was the Tide company accounts that back 2022, 23. Obviously, they're growing. You can see there the turnovers doubled year to year, gross profits doubled year to year. But it's just that um, growth, the investment into the growth that led it to make an operating loss. But looking at sort of where it should end in 2024, it should be either close to break even or at break even, or but yeah, I suppose I make the point here, and I don't know this as a fact, but kind of looking at the trajectory of it, it looks like 2025 it sort of moves into profitability. um, Especially because there's a large recurring element to this. So actually, if you look at it like a SaaS business, I'm not saying it, there is an element of SaaS in here because they do some software and different pieces as part of these packages. But actually, if you look at it in a sense of, rather than uh, treating it as a banking stock, you look at it as a tech stock. It's very, it's vastly undervalued as far as I can see. And Zopa the same. Zopa is growing really fast. It's got tie-ups with John Lewis, tie-ups with Octopus. I mean, both of those deals are just massive. Um, massive. And they've reached profitability. So will we see an IPO of Zopa? And if we do, what will happen to that 23.5 pence? Are we going to see an uplift there? I'd like to think that um, I'd like to think that there's some real value drivers for Augmentum in 2025. I don't know that. I mean, I think it's rumored, but these things do get rumored, but 30% growth. Grover as well. I mean, Grover's at break even, roughly. They had a follow-on funding of 50 million which they say will grow profitability. And they were experiencing growth, so that's all to the good. And this is kind of like an asset management play where essentially, rather than buying, say, a laptop, you essentially Grover it. You rent it from Grover, and the idea is that you pay, I don't know, 50 quid a month, let's say, for said laptop, and after, say, 6 months, you've paid 300 quid. Like, oh, if I'd gone out and bought this laptop, it would have cost me £1,000. So, like, I've wasted 300. Well, kind of one of the clever things, or at least I think it's clever, is that Grover sort of say, well, like this thing that you're renting from us, if you want to buy it from us, like, we'll give you a discount. Like, you've held it for 6 months, and we'll give you And I don't know the specifics of what they give or what the numbers look like, but I don't know. Let's say, I'll give you 200 quid off. You can have it for 800, and stop paying me 50 quid a month. Like that's their business model, and I mean, clearly somebody's, somebody's sort of going for it because they've got 500,000 customers going for that. I mean, is that something I would personally do? No, I'd probably just you know, get £1,000 out of my bank account and buy a laptop. That's just what I would do. But I can kind of see, if you're a growth business and you kind of don't want to tie up your capital, that like having an OpEx of 50 quid a month would suit better than losing £1,000 to spend on a. Anyway, that's kind of that one. Volt as well, interesting business, trying to disrupt the hegemony of Visa, Mastercard. Many have tried, few have succeeded, but it's this idea of using open banking and acting as a PSP, and but doing it internationally. That was the interesting thing. But also, and hate to kind of support Bitcoin. Well, I haven't got anything against Bitcoin. I just think that people that invest in Bitcoin will one day be crying because it feels to me like it's a speculative form of capital. But that's, we'll see. But I mean, will we one day see some sort of digital currency? Absolutely. I mean, I don't disagree with that. So this idea of being able to on and off ramp with crypto generally is, happy to support that, happy to invest into that, because to me that's a growth area. Because I just do think that what we'll see is a digital currency issued by governments, not issued by Kaiser Soze or whoever he was that came up with Bitcoin. I just don't believe that a private currency will survive. It it will be from and of government. It always has been and always will be. It's a form of political control. I just philosophically, I just don't see that we will have a world where government entities do not control the currency. That's just my opinion. But anyway, well, I digress. I shall. Oh, actually, I do want to point out Bullion Vault. I mean, again, I don't know that they've had a storming year, but I would suspect that they have. That that and 2025 should be more of the same for them. That um, yeah, and actually, they do hold a lot of gold. So even just, they're they're holding 80 kilograms of gold. I mean, that alone, I sort of did the maths and sort of, well, there's a 1.5 million profit just on the fact that gold prices changed from the value they had on their books in their last set of accounts. So this one's, we're starting to get down to kind of smaller holdings now. These are these sort of top holdings, but we've got to £1.32, and everything, as far as I'm concerned, everything in that £1.32. And this is just my opinion. None of this is investment advice. You make your own investment decisions, but to me that feels pretty like all of those seem like really good holdings. That if they were IPO'd, like, would I go and buy them? That's kind of one of the little tests I do in my mind. And I think, oh, yeah, definitely, that you could, and you could picture them IPOing. This for me was like, I just amazed me when I ran the numbers and looked at the growth of the NAV over 5 years. And you can see, there's some real impressive growth that actually when you run when you sort of run like, well, what will it look like in another 4 or 5 years if they've not IPO'd? What, like if this trajectory remains, and we can see not all of them are on, this dark green one is Grover. So Grover have dropped their NAV, and that's been down to sort of challenges around getting to profitability. And obviously in a high interest world, I suppose, you no longer have cheap capital, so it does change the dynamic. But for all of the ones where an increase of interest rates has done the opposite, that it's given you a NIM, a net interest margin, that the likes of Tide and Zopa, have gone from sub 1 billion to sorry, start again, sub 10 million to above 30 million. So have tripled their NAVs over a few years. So yeah, look, I really like, and we're out of time really to talk any more about these, but there's some really exciting holdings lower down. I mean, Artificial I thought was very, very exciting, and others as well. So I need to move on because we're at 35 minutes. I said I was going to do a quick presentation. I mean, I could talk for at least an hour about POW. POW has got so much potential. I think the news flow in 2025 is going to be spectacular. There's several Saudi Arabian holdings that are underway, that have news flow pending, that that cover lithium, gold, copper. So there's some really, really exciting opportunity, and not just short term, but longer term. And when you read across, so for example, these guys next, when you look at the next door neighbors, and by the way, the next door neighbors, excuse me, are your collaborators in Block 8. The read across is just spectacular. The level of resource and the opportunity. So I really like this one. It's incredibly cheap. It's incredibly undervalued. If I just throw this on screen, and by the way, they released their interim results on yesterday, I think it was. The net asset value as at 30th September has gone from 14 million to 20 million. So have a think about that. It's gone up by £6 million. And what's the share price done? Nothing. Absolutely nothing. So the reaction to now, anybody that's read my articles will know that six. Well, I mean, I had it as at a slightly lower number, but anybody that read my articles will know um, that was coming, more or less. I mean, not to the pen, but knew that was coming, in the sense that the ACAM or UCAM deal, as it's now called, is which is this one over here. I had that as a gain on book of 4.2. But when you look at its holding in Aruma, when you look at its holding in Red Rock, when you look at its holding in First Class, obviously First Class has not been quite as its holding in Golden Metal, well, so Guardian Metal, GMET. It's, I mean, each one of these can be game changing. Yeah, really, really, really like, and this 20 million. I mean, the market cap today is about 15, something like 15. So if we go into 15.4, so it's 25% discount to NAV. But that's based upon the Guardian Metals at 29p, 27p today. This is at 1.7p today. This is at can't remember, but it's dropped today. So all of these, I mean, this is on a discount of 85% to its net assets. Now this one's at a premium, but that's based on obviously they've not defined their resource. What's on the books is not reflective of the assets potentially, because there's the Temputi asset that's coming. So yeah, this one alone could be the game changer in 2025. But this one, again, they're on contiguous assets where elsewhere, and I'm thinking of Henlo here particularly, but they've got various holdings where the potential news flow for gold and other resources, lithium, this one could be massive, and now has some backing from 79th. I mean, albeit at dilution if it goes through. These again have got some very exciting assets, as have these. So each one of these, and that's before we even get into the whole uranium. That this uh, 10 million of exploration into the Athabasca Basin, and there's a holding over in Newfoundland as well. So yeah, I'd say, when you look at these holdings and you look at the read across, I mean, I get to a fair value of just the read across of the listed, as well as the NAV back in March of 14.5. I get to 28.6, and that's before any kind of news flow from any of these. It was also interesting to see the news flow, and I will just quickly cover this. I'm going to write an article about this soon. But this GSE agreement update issue of equity, I'm not sure people have really twigged this, that the issue of these shares was contingent upon certain profit goals being reached, and in the case of this £75,000, it was that a contract had been won of at least 160,000, which, when I did the maths and worked through the numbers, essentially, because POW own 75% of this, and I'm sort of making an assumption of a 20% profit margin. So 160, 75%, that's 120, 20% profit margin is kind of 25,000 roughly profit. So if the contract that they've won is equal or greater than, I mean, on the assumption that it's greater than 160,000, if it's a £500,000 contract, for example, when you actually do the maths, the value to POW will be greater than 75,000. Now that 75,000 dilution is paper dilution, because obviously it's the issue of shares. If the contract is a sizable one, and I mean, these contracts are sort of with large entities in Saudi Arabia and other places. So, I mean, there's every reason to think that it's not just a puny 160,000 value contract. It might be. I don't know that it's a monster, or at least, I mean, £500,000 contract's not a monster anyway. I mean, that's actually quite modest, I think. So who knows? I mean, I took that as very positive. I mean, it obviously, it's not obvious from this RNS what that means, what the implication of that means, but it's yeah, I think that we could see some really interesting news flow from quite a number of angles. And I mean, you've just got to think, like, if they, I mean, I'm just imagining here, news flow 2025, Guardian secure funding, news flow, you know, first FCM announce a find of gold, um, Athabasca. Oh yeah, we've got some really exciting results on our drilling for uranium. GSAE, we've secured this contract. It, and those things could all happen in the space of a week. I mean, theoretically. And if they did, I mean, that share price is just going to be away with the horses. I just think this one, the risk reward on it is just vast, and it absolutely baffles me that it's at 13 p bid. So this one has lost 16% this year, but I'm happy to take the 16% hit for the privilege of holding this because I'm very, very positive about it for next year. Anyway, um, I've waxed lyrical for long enough. Moving on to the next one, Fair. Fair has delivered a -1% return in terms of share price, but has delivered a 15.5% dividend. So overall, has the the tree the tree with all the money dropping off it is kind of figuratively um, kind of how it feels when you get these lovely chunky dividends. It is quite a specialist area, and you do need to be I think they describe it as an advanced, sophisticated shareholder, something like that. You've got to fill out a little quiz to kind of prove that you are. But this CLOs, collateralized loan obligations. Um, these are not sort of low risk loans. These are sort of higher risk loans. So you've got to feel comfortable about them, but these have just rolled in the cash for me for a number of years and will continue to do so in 2025. So I'm very personally very happy to hold this. I think that yeah, nothing is risk free in this world, but it just generates large volumes of returns, and they restructure things and do see it. You can invest into CLO equity as well as CLO debt, and they refinance things and just do different things to to just generate a very, very strong return. There's also buybacks. So the other part to this is that when the share price is at a discount that they are, let's go and visit it just quickly to have a look at what the news flow is doing. But it yeah, so we've got let's have a look. Yeah, so buybacks until the end of November. The latest news flow here is it's delivered so it's this one here that is the one that's publicly available. So it's delivered a 0.51% return for the month of November. And I think if you went back over the course of the year, I mean it's not delivering vast amounts of NAV accretion. Obviously, it's paying out very, very high levels of um, dividends. The dividends is the attraction here, and you can see here, it's delivered. That one there was the first one of 2024. So it's delivered eight cents on a 54 cent. Sorry, 55 cent to buy holding. So yeah, I guess that's probably I'll just move on to Pinewood. So Pinewood has done extremely well this year. It was an idea where you were going to get back 75% through the sale of oh gosh, Virtue was it? Sorry, no, it wasn't Virtue. No, sorry, it's not Virtue. It was oh gosh, Pendragon. Sorry, the word had gone out of my head. So Pendragon owned Pinewood. Pendragon sold itself, but then spun out its subsidiary, and the buyer of Pendragon also became an investor into. So it's all quite complicated, but um, the investor Lithia, it's this company here, so it's a US car dealer. So they're sort of arm's length, but they're also a customer, and there's a rollout of the Pinewood software dealer management software system to Lithia, both to its um, its dealer network, and so that's ongoing. But they've won some great contracts this year. The problem for Pinewood was that because they were owned by Pendragon, uh, you you know if you I don't know, if you were owned by Ford Motor Company, for example, Vauxhall are not going to want to deal with you because you're owned by Ford. You're owned by my competitor, so you're my enemy. So now they're no longer anyone's enemy. It's probably the simplistic way to describe it. So yeah, I really like this idea. It's a SaaS software. Lots of potential growth. I think 2025 it will continue to do really well. It's returned for me. Now it's a bit of a complicated one. It's returned minus 46%, which sounds awful, but you've got to consider the 75% dividend. So what I've done is I've spun the dividends out separately, to just and then sort of taken the hit on the 46% loss, which kind of isn't a loss. It's more of a 30% net gain, when you consider it that way. Anyway, moving on to, I think, our final two. TCAP is another, that's worked well for me this year. Hasn't worked as well as I thought it would. I mean, it's delivered 31%, so I shouldn't be too unhappy. But I did hope the spin out of its parameter would happen this year. It didn't. It's likely to be next year. So this is going to be a minority sale, a minority IPO of its data managements. And actually, when you look at LSEG and the value of its data service. I mean, the read across, parameter could be as valuable as TCI cap, if not more so. Uh, but I think the other thing that I've not seen other people talk about very much is the synergy that there is also with the rollout of its information system. So they've got now these guys deal with brokers, and they work across different divisions. So they've got the energy and commodities divisions, which, just to kind of complicate it even further, has three brands within it: Tullet, Pribon, ICAP, and PVM. It has the global broking, which then breaks down into two brands as well: the liquid net, which is then equity and fixed income, um, and the parameter is the data and analytics. The other part to this, though, is the fusion. So this has been rolled out, in the last update, rolled out to 44% of desks of brokers. But the point with fusion is that rather than having all these disparate brands and disparate services, basically Fusion just brings it all together into one place, including the parameter data. But the other part to this, and this is kind of the synergies of this, is why I sort of, when people say, "Oh, it's all about parameter, parameter, parameter," I think it's parameter. The It's all about parameter. That's where the value is. It's like, well, no, because Fusion and parameter kind of work together, where the data from Fusion goes to parameter, but parameter then is a subscription service that can be sold through Fusion. So it's actually the synergy between the two that's actually really important, and that's really valuable. So this rollout, which presumably we'll see an update where it's rolled out to a higher percentage, and 2025 will be higher still. So there's a real good runway still to go with this share, and excuse me. That's why I continue, excuse me, continue to like and think it will do well in 2025. Which brings me to my final one, which is REA. So this was a preference share. It's not many preference shares you can buy, which is a great pity, because this one was spectacular. So this one delivered. I mean, a 0% return. So the share price today is the share price that uh, 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 I ideated it at 12 months ago. However, um, again, it's the dividend. The dividend has delivered, I think, a 22.5% return because in 2024, and this is so if we go and have a look at RE, this 9%. So you get 9% based upon it being a £1 preference share. But because you can buy it now, I topped up and I bought it at 78.1p. So even though it's on a 4p spread, I actually found that when I bought it or bought more of it recently, that I got virtually the bid price, which is why I bought it. Actually, was I thought, well, gosh, 78p. So if you're getting 9p on 78p, so just show you the mathematics of this, you're getting 11 and a half, over 11.5%. So not quite as much as fair, as that, but it's still a chunky dividend, and you can see it's sort of allegedly 11.39. So I guess that's yeah, I don't know where they get these numbers from, but anyway, for me it was 11.5. Uh, and the other part to this, and I talk about it in this article, is just the discount to the NAV. I mean, it's making progress in terms of paying down debt. It's making progress in terms of um, there's as well as palm oil, there's the stone and the sand. The coal has kind of I think dwindled a little bit, but there's other interests that they have within their land that is also worth money. And I mean, a reader very helpfully pointed out that you know could these be a bid target in 2025? I mean, I don't know, possibly. And what would the implication then be for preference shareholders rather than the ordinary shareholders? Um, I suspect, again, I don't know definitively this answer, but I suspect that preference shareholders would get back £1 in the event of a sale, but it's the ordinary shareholders in this context that are the ones that would get a bid price. They are the true owners. The preference shareholders are the lenders. They're I mean, a preference share is like a loan, but it's not a loan. It is a share, but the the price you pay for being ahead of the ordinary shareholders is that yours is more of a fixed, in the same way that if REA don't pay a dividend to the ordinary people, but I suppose these ordinary people that are sitting behind, us in the pecking order are hoping for that big payout when, you know, what the preference people get is fixed, and then what the ordinary people get is the extraordinary. So if it was taken out at a 70% premium. I mean, it's at a 70% discount to NAV. So if it went at a 70% premium, that would still only be, um, again, let's just do the maths. So if it was at, it's at 30% of its NAV, if it went for 1.7 times that, it's still going for half price essentially. So 70% premium to share price wouldn't actually be that aggressive. Um, the buyer would still be getting things at half price or half the book value, if we call it that. The so which actually, I mean, now I look at those numbers, probably 70% is a little bit conservative. It could be, I mean, you could offer 100% to the ordinaries to persuade them. So look, I don't know. I mean, that's just a sort of fanciful thought, but yeah, I like. It's heading towards being 100% sustainable. Sustainable palm oil. The news flow that the the Indonesian government have mandated 40%. Biofuels is massive. I mean, when I looked at the numbers, I thought, wow, that alone is just a huge driver of palm oil prices in 2025. The fact that Jakarta, the capital Jakarta, is going to no longer be the capital, that the capital is going to be, I think this is it here, Samarinda, if I remember rightly, that the capital's here and the holdings are here. So I mean, obviously this is that's 50 kilometers. So it's, what is it, about 60 miles, 70 miles away from the new capital city. So will the sand and the stone find a home in the new capital? I mean, I don't know that, but it feels like that might happen. That could be a logical. So, again, it feels like it could do quite well in 2025. Anyway, that brings me to the end of all my ideas. I hope these 2 videos have been useful. Thank you so much for watching, and I look forward to writing more for you in 2025. Thank you so much to the people who have donated. If we just, I just want to recognise the, we're at 3330, which is amazing. 88, we're 5/6 of the way there, which is just amazing. And really sort of thank you for the comments, thank you for the feedback. I know I don't always get everything right, so really appreciate it when people say, "Oh, hang on, you've muddled up those numbers or done this or done that." We're all human. But yeah, I'm hopefully what I write is helpful to you, and uh, that's ultimately, I've got no axe to grind. I mean, I obviously am talking about my own book for the most part. um, I don't always just write about my own shares, but majority of the time I do, because that's what I know. I'm just writing about what I know. I sort of give my opinion, but I am trying to be, fair-handed and accurate. I do believe that that's really important. So where possible, I will tell you what's fact and what's opinion. I talk in terms of, my opinion is, I believe that. You've got to listen for those words, but I do try and bat a clean bat, if that's the saying. Uh, I'm not sure it is, but I'm not a cricketer, so I wouldn't know. Uh, anyway, it's the Oak Bloke signing off for 2024. Thanks again, and look forward to uh, um, writing for you in 2025. Much appreciated. Cheerio.